standing in front of a door, or imagine standing in front of two doors, one labeled shares, one labeled unit trusts. Which one do you choose? So today's webinar's whole idea is to debunk some of these myths or misconceptions. Some people say that shares are the fastest way to create wealth, and other people say unit trusts are more diversified. You've got an expert manager managing the funds for you. So yeah, the thing with shares, you need knowledge and experience and time, and with unit trusts, obviously, it's a much easier way to go. But there's no guarantees. We're both ways, and that's the end of this presentation today, is to discuss that. There's hands raised up here. Who's got hands raised? Can you guys hear me? All attendees are. Oh, geez, I hope you guys can hear me. I have no idea if this is working or not. 26. Oh, thank you. Someone answered me. Thank you. I appreciate that. Okay, cool. Okay, so yeah, so the whole idea of today's webinar is to just discuss shares and unit trust, which is the best option, which is the best first step. I have lots of people when they were first getting started, they want to get started in shares, but they've got no knowledge, they haven't got enough capital, and there's not the right product for them to start off. So hence this presentation today. So here's the agenda. Understanding the basics of between unit trust and shares, and then obviously comparing the potential returns and risks, and then just aligning your investment choices with the best product as such. So that's very basically what is today's webinar. To get started, obviously, as I mentioned just now, shares do appeal to a lot of people in the sense that they've heard a lot of people make money very fast. But it's also other side of the scale, people have also heard people lose money. So yeah, it does take time and effort and knowledge and experience. I don't say you must not go for shares, but from an investment point of view, when you're first starting investing, maybe unit trust is a better way to go. And that's what we'll discuss now. So just I'm going to show you a lot of tables. Forgive me, I'm going to do a lot of comparison between shares and unit trust, but also I'm going to do pros and cons, a lot of pros and cons between the two of them, and hopefully the pros and cons list to be able to make a decision from that. So just quickly understanding the basics of shares, call it a direct share portfolio or individual share portfolio. So the idea is that you buy shares in individual companies directly on the share market. You have to go through, obviously, through a stockbroker. The idea is that you become a part owner in a company. It does take, as I say, if you do pick the winners, what is a winner? Someone as a company has the potential to grow. It's a company that's usually in a fast-growing industry. It's got good management, good financials, etc. like that. So those are some of the criteria you look at in picking a winner. Another way of looking at it is, shares move up and down on supply and demand. You got more buyers than sellers. You got buyers pushing the share price up and more sellers pushing the price down. What makes the difference is that over the long term, the share price should be going up on, as I say, the expectation of future growth and things like that. So that's how you start picking in winners, by looking at those certain numbers. We talk about fundamental analysis, and you'll see in a few slides just now. We talk about technical analysis, looking at the charts. But as I say, third point there, it does require some knowledge. You have to do some homework, some research, and some education, a lot of reading, learning the basics of financial literacy, learning the basics of analyzing financial reports, learning the basics of charts, learning the basics of risk management. So yes, it does take a lot of time, that part. It also takes a lot of time researching the companies, and also obviously it takes a lot of time to monitor it. So that's building a share portfolio. So yes, it is higher risk if you make the poor choices. I find a lot of people go and buy stocks. They go buy, especially what we call the penny stocks, anything below R1, because the share goes from R1 to R2. You've doubled the money very quickly, compared to a company that's trading at R100, going from R100 to R200. But there's also reasons why a share is trading at R1. Once upon a time, might have been at 10 Rand, and now it's at 1 Rand. The market doesn't like it. So that downward trend tells you also about the future prospects. So that's why I talk about higher risk. Poor choices can lead to significant losses. And then obviously, a lot of stockbrokers have a certain minimum requirement. Here at PSG, we don't have a minimum investment required for shares, but obviously you have to take in consideration the trading costs. So our minimum trading cost is 230 Rand per trade. If you want to invest 1,000 Rand, you must understand that your share has to go up 23% just to break even on costs. So the bigger the transaction, the cheaper it becomes. So I suggest at least 25,000 plus, and then your cost is about 1.5%. Okay, but ideally you want to have a much more funds so you can create a diversified share portfolio. Okay, more on that a bit later. So here's the pros and cons. Obviously, on the advantages side, you've got full control. You decide what shares to buy and also when to buy and when to sell. So you got individual shares, you've got 10 shares in your portfolio. You build up to that stage where you have 10 shares in your portfolio. As I mentioned just now, a well-managed, concentrated portfolio. When I say concentrated, you want to have 100 shares in your portfolio, then you might also have a unit trust. But you know, I would say between 8 and 12 shares, spread between 3 and 5 different sectors, that would be a well-diversified portfolio. And obviously, the third point there, transparency. You log into your account, you can see exactly what's happening on each share. Most of the time, that share, the code will be linked to research and things like that. So that's what I mean by transparency. On the disadvantages side, as I mentioned just now, higher risk. If you only got one share in your portfolio, I came across a client this week there's only got one share, one gold share, DRD gold, and he's buying more and more gold shares, more DRD gold shares. That's putting all your eggs in one basket. So yes, gold has performed very well, but it will change sometime. So one bad investment, the gold price comes off, these gold shares will come off. So that's what I mean by higher risk there. So again, I reiterating this, it does require expertise, does require time. And obviously, I mentioned just now the higher cost, 250 Rand to trade. With shares, with unit trusts is a much lower cost. And then obviously also if you've got a share portfolio, the biggest thing there is human emotion. Greed and fear, your biggest enemy when it comes to share portfolios. Okay, so that's just a quick pros and cons. You can see if you add up the pros, you got 3 against 4. So if you're looking at just starting out, it tells you the numbers. Okay, there's more disadvantages than disadvantages. Just don't get me wrong. I had a client this week that he's opening up three different share accounts for his children, young children. He's putting 50,000 Rand into each one of them with the objective of teaching them about the stock market. Yes, that's another idea. And he's putting his money into a top 40, the SATRIX top 40. So yes, that is like a collective investment scheme, but it's a starting point for them to learn about the market. That I'm all for. But you got to put 1,000 Rand in, then there are better opportunities with unit trusts. So let's talk about, if you do want to go the route of shares, you have to ask yourself, first of all, am I an investor or a trader? So let's talk about investor. What makes investor is the time horizon, 3 years time, 3 years plus. It will make you, if you're buying and holding, and your time horizon 3 years plus, then you would say, we call you an investor. So it's more what we call passive management, buying and holding. Your goal is to build up a balanced portfolio of quality, undervalued and safe shares. How do you manage the risk? As you say, you spread we talk about diversification, or spread your shares between your portfolio between 8 and 12 different shares, and between 3 and 5 different sectors. That's how you manage risk with a long-term share portfolio. Okay. So yes, you do a lot more fundamental analysis, looking at more the numbers, financial statements. You go into the company's website, you can look at the latest financials, you can learn more about the company's products, etc. So you also understand also the macroeconomics. How does the company operate within the economy? What are the factors that can affect the company? So a lot more factors involved. From a strategy point of view, obviously an investor, you buy and hold, and it depends on your investment style. Some of you might be what we call value investors, the Warren Buffett approach to the market. You buy into stocks that you think are undervalued. they might be trading at 5 rand, for example, but they actually were 50 rand. So it's bargain hunting. That's what we mean by value investing. Growth investing, you're going for companies that are not necessarily undervalued, but they're growing faster than inflation. It's in the growth sector, be it IT or telecommunications, growing much faster than, for example, food companies. Okay. And one of the other strategies would be you investing for dividend income. So you go for more of those stable blue chip shares. They're giving you 3 or 4% or 5% dividend yield every year. So there's an old saying in the market, elephants don't gallop. So the share price is not going through the roof, but they're consistently giving you dividends. So there's growth in the dividends, and obviously there's the income from that dividends on a quarterly basis or biannual basis. So your main goal is obviously capital growth. You want to buy something for 5 rand and down the line sell it for 100 rand. That's capital growth. And also as an investor, some of you might say, yeah, I want to look for more investments that will give me dividend income as well as growth in that dividend income. So that's what you'll be looking at. You take out money now, reinvest into buying more shares. If I'm buying and holding and I only buy once and I hardly ever sell, I have much lower trading costs. And then the reason I also say 3 years plus is then capital gains tax applies. So the receiver says, what is your objective? I was an investor, buy and hold. And if I decide to sell after 3 years, so first of all, your first 40,000 rand or any profit will be excluded. Then they have the inclusion rate. So the maximum tax rate in South Africa, personal tax rate is 45%. Inclusion rate is 41%. So the effective tax rate is such, in this situation, would be 18.45%. You make 100,000 rand profit, less than 40,000 rand, you're 60,000. That's 18.45% of that 60,000. That's what you'd be paying in capital gains, which is much lower than income tax we talked about just now. And yes, we have all the shares that they pay out dividends. You'll get it net of dividend withholding tax. So it declares a 1 rand dividend. 20% on that is 20 cents. And obviously, you'll get net 80 cents. Okay. So that's all taken off already. So as a trader, anything less than 3 years, you'll be classified as a trader. So then there's obviously more income, and then we taxed as income. As more active management, it takes more time. So different styles, but it's still compared to buying and holding and maybe watching your portfolio once in a while. Trading might you be watching it on a daily basis. So with shares, as I said, you might have between 8 and 12 dozen shares in the portfolio to diversify the risk. I found as a trader, especially when we start looking at derivatives like CFDs and single stocks, I find the most positions I can have is about 4 or 5. Then it becomes a bit more tricky. It's like herding cats. When it comes to trading, it's not so about making money. It's more about avoiding losses. So risk management is more important. There's 2 things we always look at: position sizing and then also stop loss. So especially when it comes to CFDs and single stocks, I suggest you start with 100,000 rand. From a position sizing point of view, we work on 2%. So 2% on 100,000 rand is 2,000 rand. So you should never ever be in a situation where you're losing more than 2,000 rand per trade. So that's when we talk about derivatives. On share trading, it's a bit more difficult. And obviously, you want to have much more funds involved with that. So when it comes to trading, it's more to do with technical analysis. Remember, there's 3 questions you need to answer. What must I buy? That's a fundamental analysis. And then technical analysis from a trading point of view, when to buy and when to sell. Okay. And then, as I say, with strategy, we talk about buy and sell strategy. So you buy low, sell high. That's the idea. Different trading styles. You could be a position trader, more of a call it the active investor. You might be buying once or twice a year. Ideally, with CFDs, you'll be using contracts for difference, position trading. Maybe 2 or 3 times a year you might be trading. Some of you might decide, okay, I'm a swing trader, so I find the average there is about 12 days. You hold a position open, and then some of you might be what they call day traders. You don't hold a position overnight. You might trade a few times intraday. It's mainly the guys that trade the index futures. They get small movements, but it's high volumes, and that's what day trading is. Those are the cowboys Okay, but again, it's capital growth. You want to buy something low, sell high. With derivatives trading, by the way, you can also do the opposite. You know, I buy with shares, I buy 5 rand and sell at 10 rand. With derivatives, I can sell at 10 rand and buy it back at 5 rand. I still make my 5 rand difference. You can't do that with shares. So in South Africa, bear trading is illegal. Only way you can take advantage of falling prices is with derivatives like single stocks and CFDs. So with normal shares, if you're buying and selling, as I say, you'll have higher brokerage costs. If you're going to really want to be trading, I suggest rather look at CFDs and single stocks. Most people will start out as an investor, buy and hold, and build up the capital, and open up a separate CFD or single stock futures account just for trading. Okay. And I mentioned just now, income tax, anything less than 3 years, we could consider it as income tax. So that 100,000 rand profit you make, you have to add it onto your personal income tax, might push into a higher tax bracket. So I hope that gives you an idea. Just understand, it does take time and effort to understand, to learn about the markets, even as an investor or trader, different styles. So you have to spend a lot more time educating yourself. So when it comes to unit trusts, another word for it is what we call collective investment schemes. So your money is pooled with other investors and then managed with a professional. So you put in a 500 rand monthly investment. That 500 rand gets pooled with other investors, and depending which fund you're investing into, for example, the PSG Balance Fund, that gets pulled together, and then you'll be buying units in that fund. Okay, so what's nice about unit trusts, you've heard of the old saying, instant gratification. I want to eat my chocolate now, eat my marshmallow now. Unit trusts, you have instant diversification across many companies. So, for example, if you're buying into an equity fund, you might not only have 5 or 10 shares in it, you'll have 50 shares or 100 shares in that portfolio. So small percentages of every single little company. So some companies will do very well, and some companies won't do so well. But the average will be more than, for example, 10% or 20% per year. So some companies might be shooting out the lights, getting 50% growth. Yeah. But some other companies might be negative, and that's how you get your average growth. So that's the main advantage there. You got instant diversification. And as I mentioned, now you can also start with a little 500 rand if you want to do it on a monthly recurring contribution. And also, nice thing about that, you can set it up as a debit order, so you don't have to worry about it. So it's automatic, so it's out of your mind. And secondly, also you're taking advantage of rand cost averaging. So the market might be very high now, so you'll be buying less units at the top of the market. When the market pulls back a bit, we buy more units at the bottom of the market. So over the long term, because of rand cost averaging, your cost will be much lower. Okay, so that's a big advantage then. You can't have a debit order on a share trading account. You can have it with a unit trust account. Just be aware of that. So obviously, you also have the different funds will have different fees. But the idea is that you'll be trading on our platform, what we call the list. We're a listed investment platform, securities platform, and then we also just charge an admin fee, a monthly admin fee. If we're trading PSG funds at 0.35% a year. So, for example, you putting 500 rand a month away, 6,000 rand a year, 0.35% of that is 21 rand, which equates to 1.75 rand a month. That's your costs. Okay, so that's ideal. Unit trusts are ideal for beginners that are just starting out. Okay, so if you've got young children, it's a good way to start now is start them off with a tax-free investment plan. You've got a lifetime limit of 500,000. We talk about it just now, but you put in 500 rand a month away, they can. By the time they're 18 years old, they get a nice little lump sum. Okay. So let's talk about pros and cons. So again, you got a diversification. You're a professional manager. You got a fund manager that's looking after selecting the funds for you. A single manager. We'll talk about multi-manager funds also just now. At accessibility, you got flexibility. You can log into your account, look at your portfolio. I can switch into other funds. I can sell the units and withdraw the funds 2 days later. It takes 3 days for the transaction to settle, and another 2 days for the money to be in your account. So you got flexibility and accessibility, and that's linked to the fourth point there, liquidity, and then obviously simplicity. So it's just what I call a set and forget strategy. On the fee side, I've already spoken about the management fees and the admin fees. Only thing is you don't have control. You can't stipulate what funds, what shares the fund manager must be invested into. You'll have to go look at what the top 10 funds are. Does it meet your criteria, or those shares on your list? And that's how you look at it. Okay. And then performance. Performance relies on the fund manager's expertise, etc. But there's no guarantees. We'll talk about it also a bit later. That old disclaimer: past performance doesn't guarantee future performance. Okay, but again, you can add up the pros and look at the cons. There's 5 against 3, so it makes your decision much easier from that point of view. Okay, so selecting a unit trust fund is there's 5 steps. Call it 5 steps. First of all, define your investment objectives and your risk profile, your goals. If your goal is just to create wealth, then your goal is long term. Long term is 3 years plus or 5 years plus, as we call long term. But if your goal is retirement, then you have to look at things like retirement annuities, etc. But if you want to save towards a house or overseas trip, those are all different financial goals. It's very important to have a time horizon, because your time horizon also dictates your risk. So the shorter the time horizon, the less risk you can take on. If I want to invest a lump sum in a money market account because I need that money to go overseas in a year's time, then you're in the right market. But if I want to invest into a equity fund, my goal is to go overseas next year, I must understand that there's risk. The market can pull back 10%, and yeah, you must be aware of it. So the longer the time horizon, you're giving yourself time for the market to recover. Okay, so I hope that also fits into the criteria. So risk tolerance, we talk about being a conservative. If you're first starting out, the younger you are, obviously you take on more risk. But that's crazy to be a young investor and you're very conservative and you're putting your money into a money market account with a 30-year view. You're going to go backwards with inflation. Okay, so take on a more aggressive thing, and more exposure to the share market, a high equity fund. Worst case scenario, maybe go for a balanced fund, 75% exposure to the share market with exposure to property and money markets, etc. But you can't just put your money into a money market if you are long term. Okay, so we talk about being conservative, we talk about moderate, and we talk about aggressive. Aggressive is high equity. Moderate is medium equity, and then we talk about stable funds. Would be low equity funds. Okay, and then obviously to understand the different fund categories. This obviously indicates where and what funds they invested in, and you'll see in the next slide. We talk about these CISA, the associated. I can't remember what the classification is now, but we'll see on the next slide what they're called. So it gives you an indication of the expected outcome of that fund. Here we go. These are 3 different tiers. So first of all, you have tier 1, which is geographic. So up to 60% of that particular fund will be invested in South Africa. It's mainly equity. It could be general equity funds. Here. Okay, so it's mainly equities. 60% is South African stocks, general equity, and also depends. It comes to asset type. Asset type. That's 60% South Africa, and then worldwide, it's local and offshore. Global will be just offshore, and then regional might be exposed just to the US markets, or just exposed to Japan's market, etc. So that's what we call regional. Okay, and you can see here by equity, multi-asset, as I mentioned just now with the balance fund, you'll have some 75% exposure to equities. You'll also have exposure to property or real estate, as well as obviously interest-bearing securities and things like that. See, this is the different tiers. So obviously you'll have exposure to large cap, top 40, mid cap is the next 60 companies. You'll have exposure, depending on what the fund mandate is, what are they invested into. So this is how the CISA works out, the different fund structures. Let's go this again. So We discussed the 2 points already of the 5 steps. There we go. So the first step would be to research the fund manager and the fund philosophy, and the best source there would be your what we call the minimum disclosure document or the fact sheet. Ideally, also you want to look at company or fund managers that have a proven record of consistent long-term performance. So there are various PSG wealth funds or PSG asset management funds that have won Raging Bull Awards. You can go onto our website or you can just go Google, you'll see which of these funds have won. I can't remember offhand now. I know the PSG Diversified Income Fund is one of them. The PSG Balance Fund is also one of them. The Raging Bull Awards is the good indication of the performance. You'll see in the next slide where I highlight, or next 2 slides where I highlight a fund manager, the minimum disclosure document. And then also very important, you'll look at the costs, you'll talk about the expense ratio, we talk about the EAC cost. Each fund fact sheet will have that information. So once you decide which funds you want to buy, you'll obviously first of all register for the product, be it VIP or tax-free, set up your investment instructions, then you'll monitor it. Yeah. So you decide, okay, every 6 months I'll be looking at it. You might be looking at your portfolio once a month, look at your portfolio statement, or you can also just go onto a website and then review the fund performance. Does it meet my goals and my circumstances? Okay, so yeah, I did this 2 days ago on the 24th, on Monday the 24th. There's a tool called Funds A to Z. If you highlight it, you'll see at the bottom there, Funds A to Z. And there's a thing called a mega fund fact sheet. So it spits out all the funds available on our platform. What I've done now, I've just taken the top 20, and this is all based on the 12-month performance. So you can see now, Old Mutual, the gold funds have done very well, 143 and 142. And then from there, you can see also a lot of resource and commodity funds. So the last 12 months has been very much skewed towards commodity. We know the gold price has been running, hence has been the gold funds have been doing well. So you might have some element of gold exposure to gold shares in your portfolio, but you'd be crazy to have all your money just in gold, because as I say, past performance doesn't guarantee future performance. So right here at the bottom, yeah, you can see PSG investment management opportunity fund. This is a multi-manager fund. There's not only one fund, but you can see how we've done here. We've done 34% over the last 12 months. And you can see how this is what the fund looks like. Fund sheet. See on the, my cursor again, on the risk profile, you see we're in the upper part of the risk profile. Okay, that's where we are. You can see what shares we mainly invested into, which companies we invest into. As I mentioned, also it's not only one fund; it's quite a few different funds. An additional layer of diversification. So through one unit trust fund, you're buying into a basket of other unit trust funds. Okay, so that's what we call a multi-manager fund. So a fund of funds. That's what that stands for. The fund of funds. So you can go onto the website and be able to find all these different fund performances. You can see the performance of the fund relative to its benchmark is outperforming there. So there you see the costs. Give you all that kind of tools to make a more informed decision. Okay. We go to the next slide. There's a lot of funds available on our platform. You can see the PSG funds and all the other funds. We'll go through this very quickly. So pros and cons, if you're just starting out, unit trusts are recommended. If you're just starting out or you're new to investing, you want to start with smaller amounts, and you want to have more hands-on approach, and you want a professional fund manager, then unit trust is the way to go. So you value diversification and you value reduced risk. So as a beginner, I suggest unit trusts. Shares might be more suitable for you if you've been involved in the market for a long time, or you've got a background in the stock market, you studied at university, whatever the case might be, but you have a strong knowledge of the stock market. Okay. You're comfortable with risk and volatility. Okay. and you want direct control of your investments, then having a share portfolio is the way to go. Okay. But most important, you have enough capital. I suggest at least 100,000 rand to build a diversified share portfolio. 100,000 rand, 25,000 to each of them. You got a portfolio of 4 different companies, and over the period of time, you're going to add more money to it, lump sums, and you build up a portfolio. So that may also help you just make a more informed decision. So comparing the potential returns and risks, I'm going to go through very quickly. Obviously, from an individual share portfolio, low concentration, it's very low if you're concentrating just one sector, just having gold shares. So you want to spread it out properly. Again, between 8 and 12 different shares. You don't have too many shares. You have to do research. You want too little shares. You have to, then your eggs in one basket. Okay. Volatility, very high volatility, obviously, the share market, especially if only one company. You know, spread that risk around. It does require your own research and monitoring, and I'm repeating myself here. Regulation. There's obviously the stockbroker has got a lot of rules in that to adhere to, and your trading is monitored all the time by the JSE and things like that. So they do pick up anything that's untoward, but if anything happens, you are protected with a whole lot of different things from our side. Unit trusts, we mentioned just now, you got high diversification with unit trust portfolio. Volatility is obviously much lower because you're spreading it out a whole lot of different funds. Managers looking after your funds for you, and then obviously like very highly regulated, very similar to the market. Compared to, I'm going to use an example of crypto. Crypto is not a regulated market in South Africa. That's why PSG doesn't advocate it. But these markets and unit trusts are regulated. From potential return, obviously much higher returns of shares. The top 5 performing stocks this year have been the top 4. I think I saw a presentation yesterday. The top 4 were all gold stocks. I mean, Sabania, Goldfields, and DRD. The top one was Choppies, which is a small little retail company, and they went up 300%. But again, there are potential returns there. It's just picking the winners. Unit trust over the long term, you should be looking at least 10, 15, 20% growth per year, and obviously adding to that all the time. Income generation. So from a share portfolio, this is where you have dividends. If your goal is to put dividends on the unit trust side, any income from interest and dividends are reinvested back into the fund. So it depends on which kind of fund you're looking at. But most of the time it's reinvested to buy more units. Costs are obviously much higher with shares. You've got the normal brokerage fee, sliding scale, as well as a platform fee. We pay a monthly admin fee of 95 Rand plus that, and we raise admin fees on the side here. Okay, so again, hopefully it helps you make a decision. So aligning your goal, your investment choice with your personality traits. So there's 3 or 4 things we look at. So from a personality point of view, do you have the patience and discipline? So investors with higher levels of patience and discipline would be more skewed towards a buy and hold unit trust portfolio. You can also move towards a share portfolio if you are more disciplined. So with shares, obviously, we've spoken about it just now. Can you handle the stress in that when the market pulls back? With unit trust, you don't have to worry about it. But also say to people when they're first starting out, putting 500 Rand a month away over 12 months for 6,000 Rand, market pulls back 10%, you've lost 600 Rand. How do you feel? Most people say, ooh, I wouldn't like it. And then it tells me a bit more about the risk appetite and risk profile. So you're going to go for more moderate than aggressive unit trust portfolios. Okay. We talk about also coming back to emotional response. We talk about our SWAN strategies. It's an acronym, stands for sleep well at night. Now, if you've got a share portfolio and it's keeping you up at night, you can't sleep, then that share portfolio is not for you. Rather go the unit trust route. Okay. Financial goals. We touched on this already. Short-term goals. Anything less than 3 years. and obviously your strategy is different. To be more preserving capital, more low equity to moderate. Longer term goals, you can take on more risk and have more exposure to the share market. From a retirement point, annuity point of view, you are restricted with what we call Regulation 28, maximum 28%. Sorry, maximum of 75% exposure to shares. And that can be split. The balance fund, I think, is 50-50, 35% local and 35% offshore. So that's a nice little spread of having exposure to equities. Okay, but it's important to have those goals and then having those time horizons. And then again, your risk tolerance. So where do you fit in? Are you conservative? Are you a bit more moderate? Or are you a bit more aggressive? So that also tells you a bit more about where to invest and things like that. So more speculative assets, you might be looking at more share trading and more derivatives if you're an aggressive trader. Okay. So what's important also is to align all these strategies with your goals. So later on, you might want to go through financial advisor, but the idea is to document your goals. What is my goals? What is my risk tolerance? And then once a year, look at your portfolio and then compare it to your document. Am I on track? But ideally, you want to be sitting down with a financial advisor and say to him, this is my goals, help me to achieve it. Okay. So a well-diversified portfolio helps you towards that sleep well at night philosophy. But also, again, regular review. Gone are the days you buying shares and forgetting about them. Put them in the bottom drawer. Now, you have to be watching the markets all the time. Okay, so that helps you, give you a bit more alignment. We have various investment products. I've touched on this before. VIP is a great savings tool, great for saving towards a certain goal, be it a house or car deposit. More from a tax point of view, from a tax efficient point of view. Endowment is a 5-year investment tool. As many for people that have a tax rate more than 3%. Within the endowment, any growth within the endowment. So there are certain restrictions. They talk about the 120% rule. Can't go more than 120% of the previous year's contribution. So ideally for big lump sums, big amounts on a monthly basis. So it's for the big investors. Tax-free, any growth in the tax-free account, ideally long-term. Capital growth, income from dividends, income from interest is all tax-free. So it's a great savings tool to complement your retirement annuity. So you got a maximum of 500,000 lifetime on the tax-free. Annually, you got 36,000 or 3,000 rand monthly. If you can afford it, rather look at the 3,000 rand monthly and then use what they call rand cost averaging. But the idea is that it's longer term. Divide that 500,000 by 36,000 a year. It's roughly about 13 years. So a nice way to build up a nice big lump sum before taking the funds from your retirement annuity. You can use that to pay off your debt and things like that from the tax-free. And obviously, retirement annuity be your first priority when you're first starting out. If you've got a pension or provident fund of your company, join it, and obviously you want to try and maximize it completely. 27.5% a year, up to 350,000 rand. That's your starting point from an investment point of view, and then your tax-free would be to complement that, and then your voluntary investment plan would be any savings tool shorter term than that. On the share side, we've spoken of it before. You can go local and you can go offshore. Offshore, obviously, it's more for the, I'll call it more advanced investor, a bit more risks involved, currency risk and political risk, etc. But you can see there also, we recommend at least 1.2 million to have a diversified portfolio. But yeah, those are the different ways of going offshore. Right, guys, I'm running out of time. Gone a bit over time, big ways. So, summary, unit trusts are safer, more practical way to get involved in the market because of its diversification, because of the professional management and low barriers to entry. Those 5 steps to selecting your funds, your goals, and your time horizon is important, as well as your risk profile. But also, as I say, we have a whole range of unit trusts to choose from, and we have a whole range of different investment products to help you get there. So in conclusion, there's all those different products I mentioned just now. You can go click on them. It's a highlight for you the voluntary, what do you call the key information document. You can learn more about them. But yeah, let me see what kind of questions you guys got. I'm sorry, going over time here. Get excited. Guys, thanks a lot for being on this webinar. Thanks for your support throughout the year. Our first webinar will be at the end of January, and I'll be putting it out again. But thanks for your support, and we'll take it from there. Thank you very much. Bye for now.